What's up, everybody? Excel Dude coming at you again. Today we're going to talk about some capital budgeting in terms of what projects are useful, what isn't, and a few functions. We've got net present value, we'll go over internal rate of return, and return on investment. Just some quick ways to evaluate whether a project's worth it for you or not. If you've been liking the content, hit that subscribe button on the bottom right. I'd appreciate it. Helps me get out to more people. Let's go. So you're at a business. You either own it, work at it, you're making a decision, something along those lines. You need to know if an investment is worth it for you. All right, we can enter this. So let's say you have the option of investing in something that will give you 5% per year. You have $30,000 to invest. Should we invest in the 5% return, or should we buy this new machine that's going to provide us different cash flows? This one, let's say each year it's going to give us $9,000. Initially, it seems like a no-brainer. Yeah, I'm going to make 50%. If I put 30,000 here, I've got 45 coming in over time. Overall, I'm going to do this. I'll make $15,000. I'll look like a genius. Not necessarily. That's the cash-on-cash return, and that is not how you evaluate a capital project because there is the time value of money. And we use this function here to talk about the time value of money. Basically, think of it as like an interest cost. Like nothing is free. Time is just, money's just a way to account for time. It's a way to store, essentially, the value of your time. If you think about it that way, it makes a little more sense for me. So here we're going to do this function right here, NPV, net present value, equals NPV. What's our discount rate? Our discount rate is our cost of capital. Let's assume that it's an even 5% and it doesn't change over time. So we click that, comma, and then you're just going to click all the cash flows. Highlight those, close it up, hit enter, and there it is. So you're not making this $15,000. When you factor in every year this discounts by 5% and the cost increases over time, because if you think about it, you would have made 5% on this year one, 5% on that, 5% on that, so then 10 on this here, or 10 on this over here, 10, 15 over here, and so on. It compounds. So really what you're going to make is about $8,500. So if you take a look at that, boom, over, yeah, let's say 30,000. Yeah, you're making about 28%, which is still pretty good. It's not bad. Depending on what you're looking for, that might be exactly it. Sure beats 5. Anyway, we'll look at another one here. Discount rate. Let's say you're looking at, I don't know, maybe let's say a rental property. I don't know where the hell you can buy for 150 grand anymore, but still. You do that, and you go 150,000. Every year you'll make 20,000, which again is probably large for that initial assumption, but still. At first it looks like over time, yeah, you add these up, in 10 years you're going to be up $50,000. You've made 33%. Fantastic. However, you look at net present value, you discount it 8%. Let's say you have a cost of capital of 8%. You could have made it elsewhere. And you just add those values in here. You're losing 51,000, so you're actually destroying a third of that original investment. Not a good move. Now if it drops to 7, it might be a little different. Drops to 4, yep, you're still there. If it's 0, yeah, by all means, you're making your cash on cash return 0%. But I don't know anyone that's going to loan money at 0%. So talking about the time value of money again, it's just $1 today is worth more than $1 tomorrow. So think about it this way. You've got someone who owes you money. They say, I'll pay you on Friday $100. All right, cool. Let's say they're good for it. You know they're going to pay you. You have some type of contractual obligation. But they say, you know what? I have $99.95 today. I can send you that. Maybe instead of Friday, call it even. You say, you know, I think I will take that. Okay, send it over. Once we're good, we'll call it square. That's the time value of money. You're basically willing to take a nickel less because you get the money today, so you can invest it. You have, say, 5 days to do that. You can, in theory, make more than the nickel, or maybe you just have cash flow needs or something along those lines. It's why vendors offer payment discounts for 210 net 30, stuff like that. Essentially, it's just you'd rather have it in your pocket now, or a bird in the hand's worth two in the bush, that kind of thing. Internal rate of return is another way to look at them. This is a super easy function. It's literally, you get your cash flows. So we paid $3,000 the first year for a new project or a new piece of equipment. Year 1, we made $1,000 extra. Year 2, 15, 17, 15, 4, and 5. So over these years, it ended up increasing revenues by $87.50. So let's look at that. Excuse me. So we had another 8,750 that went in there. And we had to pay out the $3,000 negative. So our cash on cash return, but yeah, 5750, that seems great. Awesome. Not the case though. What you're doing with the internal rate of return is you're finding the interest rate and you're allowing Excel to do all the computations for you. And it's going to calculate what this money, $3,000, would have to be compounding at every single year at a constant interest rate to equal these cash flows in this period of time. So all we do equals IRR, values, close it up, wham bam. So this would have to compound at 42% each year to make sure it worked. And there you go, that's internal rate of return. So another way you can kind of view your projects, things like that. Then you can go with your return on investment. It's slightly different. It's similar to holding period return. Basically, you look at it this way, and you're going to take, let's see, the ending value minus beginning value, and then val, I don't want to type that out, and you divide it over beginning value. So right here, F2, we'll look at this. So we're taking our ending value, 118, minus the beginning, 100, divided by 100. So it's essentially taking the difference, 18 over 100, and that's going to equal our 18%. So 18 is 18% of 100. Then you'll go here. This is going to take 97 over, and you do it with 118, and so on, and so on, and so on. This is just to show you a little bit more about how you'll see returns that over time they're smoothed kind of thing. You'll see a lot of this in real estate indexes, things that have maybe less liquidity, potentially alternative investments, or anyone who wants to show you a return of, over the last 30 years, the stock market's up XYZ. Yeah, it might be up, say over the last, what, 1, 2, 3, 4, 5, 6 years, assuming we're in the future, 19%. Sure. But really, if you were buying and selling every single year, your return comes out to closer to 10%. Because you had this 18%, which is great, then you went down almost 20, you went up 30, you went down 14, and so on, 36. This is looking at it all as a reference to this period. So what you've got is the original cost basis, and this would be more like your tax accounting kind of thing. So again, in reality, like, hey, guess what? The IRS wins again. But that's sort of, it shows you how you can smooth an index and make things look maybe a little better, kind of slant the data towards your design here. But that's it. ROI, holding period return. You give a single period or since inception from the start. And that's about it. If you liked it, thanks. Hit that subscribe button, and I'll see you next time.